Hello and welcome to Crossing the 49th, the Cross-Border Tax and Financial Planning Podcast. I'm your host, Phil Hogan, and today we're going to talk about how interest, dividends, and capital gains are taxed for U.S. expats living in Canada. Okay, so let's get started. So what we're going to talk about today is how interest, dividends, and capital gains are taxed for U.S. expats living in Canada. Now, the taxation or the consequence of taxation for some of these items will be quite different if you're not a U.S. person. So we won't get into taxation of U.S. dividends and capital gains for non-U.S. persons or Canadian tax residents. But just know that those rules are certainly different, and certain withholding taxes might be applicable. But in this case, we're only really just talking about interest, dividends, and capital gains for U.S. expats living in Canada. So let's start with maybe one of the easier ones to walk through and explain: interest. So, as an American living in Canada, if you earn interest, whether that interest is from U.S. sources or from Canadian sources. So that could be interest on a U.S. bond, that could be interest on a GIC, that could be interest on a municipal bond, which, interestingly enough, would be tax-free in the U.S., but taxable in Canada. Interest is only taxable and when I'm going through this, I'll be referencing the treaty. So, when I talk about the treaty, we're talking about the treaty between Canada and the U.S., So interest, pursuant to the treaty, interest is only taxable in the country of residence. So when they talk about the country of residence, you're a U.S. Taxpayer, but you're living in Canada, so your residence is Canada for tax purposes. Interest is only taxable in the country of residence. Therefore, that interest will only be taxable in Canada. Now, that doesn't mean that it doesn't get reported on the U.S. return. In most cases, income will get reported for both U.S. and Canadian purposes. So 100% of in most cases, 100% of your worldwide income will be reported on your 1040 and on your T1 Canadian return. However, by using foreign tax credits, you'll be able to eliminate double taxation, and then you'll get to properly sourcing that income and paying tax to the respective country. So for using interest as an example, Canadian interest will be taxed on the Canadian return. It will also be taxed on the U.S. return. However, all the taxes you pay on the interest in Canada will be available as a credit on the U.S. return, which in most cases means you don't end up paying any tax to the U.S. on that interest. Now, if you earn interest from U.S. sources, that'll be treated quite differently. So you'll also have interest being recorded on the Canadian return and the U.S. return. However, because the income needs to be, or the interest needs to be taxable only in Canada, you'll get what they call the resource credit in the U.S. So interest will be resourced back to Canada, and therefore you won't pay tax on that interest in the U.S. So when I talk about foreign tax credits for U.S. purposes, we're talking about Form 1116. That's the foreign tax credit form that we'll use to apply foreign tax credits on your U.S. return. So yes, interest. So to recap, interest only taxable in the country of residence. So in most cases, U.S. expats living in Canada, you'll only pay tax on your interest payments to Canada. So that one's relatively straightforward, other than resourcing the interest. So let's tackle dividends next. Capital gains can be a lot more complex. So let's talk about dividends. So in most cases, clients will receive dividends from either U.S. public companies or Canadian public companies, and in some cases, other international companies. But for purposes of this podcast, let's just talk about dividends from U.S. public and Canadian public companies. And of course, for our corporate business clients, they might also receive dividends from their Canadian corporation. But that conversation about Canadian corporations and private share ownership with U.S. citizens is a very broad topic and not something we're going to get into today. So taxation of dividends. So under the treaty, dividends will be taxable dividends will be taxable to the country from which they were paid, but only up to a maximum of 15%. And of course, there's a bunch of other rules with foreign company dividends and foreign corporate dividends, but just for purposes of just straight portfolio income, you'll be taxable in the US and Canada with respect to where the dividends were paid from. So let's use a simple example of US citizen living in Canada earns $1,000 in dividends from a Canadian corporation, a Canadian public corporation, something like BC, let's say. That dividend will be taxed on your Canadian return. And of course, as we know, the taxation of dividends for Canadian purposes is quite complex in that we have dividend tax credits and different rates. And the reason we have that is because we have a level of tax already being paid on the dividends from the company, and then a secondary layer of tax being paid by the individual. But we're not going to get into that today, but just know that there's a preference rate on dividends from Canadian corporations. So you have a Canadian taxpayer, US citizen living in Canada, receiving Canadian dividends or dividends from Canadian corporations, public corporations. That dividend will be taxed on the Canadian return at whatever preference rate will be calculated for Canadian purposes. That dividend also will be taxed on the U.S. tax return, and then any tax that the individual paid in Canada will be a credit against that tax in the U.S. under that Form 1116. And when you're doing 1116 forms, you'll have a passive form, you'll have a general form, and you might have a resource form. So you're not only filing one 1116 per filing, you might have multiples. And that tax that you pay in Canada will be a credit on your U.S. return, and you will likely not pay tax to the U.S. on that dividend. Now, dividends are interesting in the sense that if most of your income is only dividends, that can be tricky, and you might pay a very low rate of tax in Canada, and you might end up paying tax to the U.S. on your Canadian dividends. And in a lot of cases, that doesn't happen because the preference rate on even dividends from Canadian corporations to U.S. persons on their U.S. return is low, but that can be a situation where you might not have enough tax to offset U.S. tax. But in most cases, you will, and you won't pay tax on that dividend in the U.S. So let's look at that example. If the dividend received was from a U.S. public company. So if we receive a dividend, or American living in Canada receives a dividend from a U.S. public company, in a lot of cases, they'll withhold on that dividend to a Canadian resident. We always have to remember that regardless of the withholding, that's not going to be the final tax for U.S. persons. Now, if you're not a U.S. person, then that is the final tax, because you're not filing an actual U.S. return. But the withholding that you would pay upon receiving the dividend, it will be a credit on your installment or on your U.S. tax return, as if you made an actual installment. So irrespective of the actual withholdings, the tax treatment will be the same. So once again, let's go back to this. We have we have a U.S. dividend from U.S. public company. That dividend will be taxed for U.S. purposes, like it would normally be taxed. It will be taxed for Canadian purposes as a foreign dividend, or just foreign income. So there's no preference rate in Canada. You pay full rate tax on that dividend. And then, as we know, we're not paying double tax because the treaty is in play. So you get a credit for the dividend in the U.S. On your Canadian return. So whatever taxes you paid in the U.S., you'll get a credit on your Canadian return against the taxes that were calculated for that dividend. Up to, and this is where things can get tricky, up to 15%. So you can only get a credit to a maximum of 15%. And in most cases, you're probably not paying that necessarily, and maybe in some cases, but let's say you're not paying that, which would be fine. In cases where you are paying more than 15% in the U.S., it gets really tricky, because then you have to go back to the U.S. return. You have to complete a resource 1116 to reduce down the tax from, let's say you're paying 20% on the dividend down to 15%, because you can only get 15% in Canada. Anyways, we're getting out of the scope of this podcast, but just know that the maximum you can get as a foreign tax credit in Canada on that dividend is 15%. Once again, you shouldn't be paying twice, but you might have to do some additional calculations and some forms to reduce down your tax on that dividend to 15%. If not, so for instance, let's say you did pay 20% on that dividend to the U.S. on your U.S. return, and you properly calculated your Canadian foreign tax credit. And if you didn't properly calculate it and CRA reviewed it, which they often review foreign tax credits, they would disallow anything over and above 15%. If you didn't do anything, then you would actually end up paying an extra 5%. So you'd pay the 20% in the US, you would pay 15%, or you'd pay whatever you'd pay on that dividend in Canada. You would only get credit for 15%. So then that difference between the 20% you paid and the 50% you got credit for is 5%. That would actually be double tax. So that's why it's important to do these calculations properly, know how to calculate foreign tax credits based on what the treaty says, because it all seems easy to calculate until you get a letter from CRA telling you that you didn't calculate the amounts correctly. So okay, so we went through dividends, we went through interest. Now let's talk about the taxation of capital gains for U.S. citizens living in Canada. So for purposes of capital gains, and this one can get tricky too, because when we think about capital gains, we can have capital gains on lots of different property. We can have capital gains on stocks. We can have capital gains on real estate. We can have capital gains on sale of business property. But let's keep this conversation to capital gains on stocks. So this would just be securities in your non-registered investment accounts, so your U.S. investment accounts and your Canadian investment accounts, but not in your RSPs or your IRAs. And then we can talk about capital gains on property. Okay, so when we're talking about portfolio gains, so there'll be gains from securities in your portfolio, stocks, bonds, mutual funds. A little bit more tricky than dividends and interest. So the way the treaty reads is you're only taxable on your capital gains regardless of the source, and I'm only talking about public securities here, in the country of residence. So very similar to interest. So if you sell stock on the U.S. stock exchange or Canadian exchange and you're a U.S. citizen living in Canada, you should be taxed only in Canada. Now, sounds simple, but you have to figure out how do you make that actually happen on the tax return. So let's go walk through a couple scenarios. So scenario one, you buy a stock on the Canadian, on one of the Canadian exchanges, a Canadian company for $100. You sell it for $200. You have a $100 capital gain. That'll be taxed on your Canadian return. And of course, as we know, we pay, for now anyways, we pay 50%. You pay tax on 50% of your gain, and then there's threshold amounts of that based on the new rules. So you pay your Canadian tax, and then for U.S. purposes, what you wouldn't do is you wouldn't take the $100, and when I should kind of walk back here a little bit. When the conversation with interest and dividends, of course, we're converting that income from either Canadian dollars, U.S. dollars, respectively, on each return at the respective rates. So income like interest and dividends are going to be converted at the average rate, where capital gains are going to be different in that you will convert your purchase price ACB or cost base at the rate at which the day in which you purchased it, and then you were going to convert your proceed price on the day in which you sell the security. So that's how you would actually calculate the capital gain on the U.S. side, which would be much different than if you just converted the $100 capital gain at that particular date. So you really have to make sure that you convert cost basis and proceeds on their respective date for both Canadian and U.S. purposes. So once you do that, $100 capital gain in the U.S. or in Canada, whatever that ends up being in the U.S., you take the tax that you paid in Canada as a credit on your 1116 in the U.S., likely don't pay any tax on the U.S. return. little bit trickier. When the inverse is true, when you pay, when you have a capital gain on U.S. security on a U.S. exchange, it will get taxed on the Canadian return after it gets converted to Canadian dollars, the cost basis and the proceeds, that calculation. And then on the U.S. return, same thing with the interest, is you will resource that gain from the U.S. to Canada on Form 1116. You will wipe out all the tax on that gain in the U.S., and therefore you will only pay capital gains on, or tax on the capital gains in Canada. And this, I see this error a lot on Canadian returns, or sorry, on U.S. and Canadian returns, where they don't resource the credit, try to take a credit on the Canadian return for the U.S. gain. So that's incorrect. You wouldn't get a credit on your Canadian return for U.S. gain. You will resource it in the U.S., wipe out the tax on the U.S. return, and then just pay capital gains tax on the U.S. capital gain on the Canadian return. Now, I know that sounds complex, and that's because it is. But I just kind of wanted to walk through some of these examples because you'll get lots of questions about this. I see lots of tax returns with incorrect calculations. So yeah. Yeah. So before we finish up, that was resourcing and regular treatment of capital gains on the Canadian U.S. return. If you have a capital gain on rental property, that will be quite different. Rental property will be taxed, or gains on property, like rental property, U.S. situs assets, will be taxable in the country where they reside. So if you sell your California rental property, you will tax it first in the U.S. So you'll tax on your federal return. You'll tax it on your state. You'll have a state return, non-resident state return. And then you'll tax it on your Canadian return, and all the taxes you paid in the U.S., both federal and state, will be a credit on your Canadian return. And then the inverse is true for sale of Canadian property, where you'll be taxed. You'll report it on both returns, but you'll get a credit in the U.S. for all the Canadian taxes you paid. Rental properties can be tricky because in cases where you have state taxes that apply, you'll have to file an additional state return and tax that amount in the state, and then get a credit for that tax in Canada. In most states, when you sell property, unless you're under like a de minimis rule, you'll pay tax to the state on that property sale. So we covered tax on interest, dividends, and capital gains, both public securities and portfolios, and rental properties, very briefly. So I hope that was helpful. If you found that information helpful and you've been finding this podcast helpful, it's a great assist to the channel to like, comment, and subscribe. Share with some friends, that would be great. If you're not already a part of the Facebook Americans in Canada group, that's a great place, great resource. We have an amazing community there. It takes a lot of time to moderate that, to keep the bad actors out, but great community right now. If you're interested, we do offer a complimentary cross-border tax and investment consultation. I'll put the link below. Make sure to sign up quick because those spots do go very quickly. And once again, I want to thank everybody for their support over these number of years with the channel and the podcast. Greatly appreciated, and we'll see you on the next one.